Hello, everyone. Good evening to all of you. Thank you for joining us today for this session, which is our usual monthly short Zoom sharing session, right? To share about the markets and what has been happening recently. So again, this would just take about 30 to 45 minutes for me to just go through the main issues that I want to address today. Okay, so before we begin, let me just flash this usual disclaimer over here. So what I'm sharing tonight is not a financial advice. They are just my personal opinion for sharing for educational purposes. Okay, so before you make any investment decisions, please do your own due diligence. Okay, so this is the agenda for the sharing today. These are the main issues or main events that I would like to talk about and share a little bit about my views. Okay, about the current inflation situation. Then recently there was also rumors about the fall of Credit Suisse, right, and recession, as well as all the headwinds for Singapore REITs with regards to the rising interest rates and how we can actually analyze the situation. Okay, so before I begin, allow me to just very quickly share with you guys that the next upcoming workshop that we have in November on Singapore REITs, it will be held on 6th November, which is a Sunday, right? So for those of you who are interested to learn how to start on income investing, okay, you can actually scan the QR code to find out more details about this upcoming workshop. Okay. Okay, so let's start off with the first agenda of today, which is to talk about the stubborn and sticky inflation. Over the last few sharing, we have been talking about the topic of inflation. Now, the most recent CPI data that came out was that September's overall inflation rate, it came out to be 8.2%, right? Which was higher than the expected, okay, but lower than the previous month of 8.3%, just slightly lower, okay. But what is making more people worried about is this core inflation. Now, what is core inflation? Core inflation excludes the food and the energy components, right? And core inflation, it came out to be at 6.6%, which is higher than the previous month of 6.3%. Okay, so this is what people are talking about these days and what they are actually worried about. Okay, I think I've spoken enough about inflation in my previous sharing. So whatever I have shared before in the previous Zoom sessions, I'm not going to repeat them again. Okay, it's not I sound like a broken record. So, but what I want to point out today is that before we panic over the not so good CPI data, we need to understand the CPI data first, okay? So we have to remember first thing that we have been talking about a lot, which is that CPI data, it is lagging, okay? And in particular, if we understand the composition of the CPI data, shelter component, which is housing, it takes up a weight of about 30% of the overall CPI data, that means of the overall inflation, and 40% of the core inflation data, okay? So why do I want to mention this, right? Because what this means is that the housing market, it plays a big role in the CPI data that we are seeing right now, okay? Whether it's the core inflation data or the overall inflation data. So why I want to bring up this is because we all know that housing market, okay, the housing prices, rental prices, it has been on the rise since COVID. And it only started to cool off in recent months. It was only until recent months before we started to see the housing prices coming down a little, right? As well as the rental prices. Okay, so we started to see some softening of the rents as well. Okay, let me show you this chart over here. Now, take a look at this chart over here. Okay, this chart tells us the year-on-year rent trend, okay, in the US. Okay, the US median rent. So the gray color graph, okay, it represents the year-on-year growth percentage, while the red color graph represents the absolute amount of the median rental price, the absolute amount of the rent. So what we can see over here in this chart is, can you see that this gray color one, it has been coming down, The gray color one has been coming down. And what it means is that the year-on-year growth for rent prices, it has actually been decelerating over the last few months, which means to say it is slowing down. There are signs of a cool down in the rental prices. Of course, the prices are still very high, okay? Because if you look at the red color one, it is still very high, right? But there are signs of cooling down in the housing market. But what is the problem here? Now, the problem is these are not yet reflected in the CPI data yet. Why? Because it's going to take the CPI data, remember, it is a lagging indicator. It's going to take some time before all this gets reflected in the CPI data. Because there's so much increase in the housing market that have already occurred that we are not going to see the shelter CPI coming down that quickly yet. Okay, let me also prove it to you using some numbers, right, to show you that the CPI data for shelter, it is lagging the real-time housing market. Okay, so let's do some simple computation. Okay, so firstly, let's understand that CPI for shelter index, okay, it is made up of two components. The first one is owner's equivalent rent of residences. The second one is this rent of primary residence. Okay, so we break it down into two components, right? So now let's try and plug some values off from each of these two component indices, okay, which represent the CPI shelter, as well as from the US National Home Price Index, which represent the housing prices for the housing market. Okay, and then we'll compare them year on year. Okay, so I have done the map here. Okay, so you can see over here, there are two tables. Okay, the first table on the top, it comprises of the value of the indices that we have plucked out for the month of August from 2018 to 2022. Okay, so for simplicity, I just take the August data, okay, for each year, and I do a comparison year on year. Now, if we look at the second table at the bottom, okay, it tells us the change in index value. So what I did was simply, I take, for example, this 3.3% over here. This 3.3% over here is I just take the August 19 minus the August 18 data and then divided by the August 18 data to see what is the change in the index value, okay? So what we can see over here at the second table is that the change in the shelter CPI component, which is the first two, it has actually been decelerating from 2019 to 2020, as well as from 2020 to 2021. Why? Because you see the percentage change is actually getting smaller. So it has been decelerating, right? The change has been decelerating because the number is getting smaller. And it only started to accelerate from 2021 to 2022, where you see the number changed from 2.6% to 6.3%. And I went to color code it as green color. Okay, so this is for the change for the CPI. But let's take a look at the index that represent the US housing prices. What is happening from 2019 to 2020? It has actually been accelerating. Can you see the number is getting bigger? That's why I highlight in green color box. And then from 2021 to 2022, the number came down. It has been decelerating. Okay, so what this table or what all this computation can tell us is that the CPI data, it only picked up the accelerating growth in housing prices sometime after it has happened. You see, the housing prices, okay, the growth has been accelerating since 2019 to 2020 to 2021. But all this will only picked up in the CPI data when from 2021 to 2022. Okay, so and right now when we see that the housing prices the growth has been decelerating, the CPI data is unable to reflect that yet because it is lagging. Okay, so this is just one simple calculation that I've done. Okay, the numbers I just plucked it off from the St. Louis Fed website to show you that the CPI data, it is indeed lagging. It is lagging the real housing market prices. And because the housing market has already increased by a lot over since 2021, since COVID, it is going to take some time before we see the current housing market, okay, the current situation being reflected on the CPI data. And that's why we go back to the first point where we talk about how the CPI shelter, it represents 40% of the core inflation data. And that is also why the core inflation, it is still increasing because you can't expect that the CPI shelter data to fall right now because it is lagging. Okay, it is currently reflecting the boom, the growth that has happened in the past. Okay, that's why when we look at CPI data, it is not real time now. Okay, and that is also why we don't have to really panic when we see that, hey, how come the core inflation is still increasing at this rate? Okay, so this is similar to what Jeremy Siegel, okay, the Wharton professor, has said in a recent interview, right? He talked about how from March 2020 until the peak of the housing market this summer, indicators show that housing market has been up by 14%, but the CPI housing factor was only up by 11%. Why? Because the CPI is lagging. It hasn't picked up all of the increase yet. Okay, and which is also why we do not expect that we would see that the CPI housing factor would come down drastically immediately, in the next month or so. Okay, but is that something to worry about? No, because we shouldn't focus only on CPI data because it is lagging, right? Instead, look at the housing market directly to see whether there are signs of cooling. Just like previously in previous sessions, we shared about how you can look at crude oil prices, natural gas prices to tell, whether the energy market is cooling. Same for housing market, because CPI data, it is lagging. So if we are going to only focus our attention on the CPI data that is released every month, you're going to get a big shock because there are things that have not been reflected in yet. Okay, and if you want to wait until it comes down, it's going to take some time. It's not going to happen immediately. Okay. So this is for the inflation part. Okay, the second thing on my agenda, on my list, is to talk about the Credit Suisse event, right? I think some of you might have heard about this Credit Suisse event. What happened was that there were rumors going around that say that Credit Suisse is collapsing, and it sparked concern that there is a possibility of Credit Suisse becoming the next Lehman Brothers, igniting the next big financial crisis. And it seems that how all this speculation started was that there was this tweet on Twitter by this guy called Spencer Jacob, who is a journalist at the Wall Street Journal. So he tweeted this tweet. In his tweet, he tried to draw some similarities between what Credit Suisse CEO said and what the Lehman Brothers CFO said back in 2008, right? And in the same tweet itself, he also attached this image over here. Okay, what is this? This is a chart showing Credit Suisse CDS spread shooting up to all-time high, right? Shooting up to 14-year high and at a level which is comparable to what we see during the 2008 financial crisis. So again, such news, it shows us that we need to take the financial media with a pinch of salt, right? What we see on social media, financial media, right? Take it with a pinch of salt, because many of them tend to blow things out of proportion to attract eyeballs. Now, so first, let's try to understand this situation over here. Now, what is this CDS? Okay. So let's try to understand what is this CDS. Now, CDS stands for Credit Default Swap. Okay. And what is it? It is actually a financial derivative which transfers the credit risk in the event of a default. So it is actually, you can think of it as like a form of insurance against the default of the borrower. So how it works is this. So on one side, we have the bank, okay? So the bank will issue a debt instrument, for example, a bond. Then on the other side, we have the investors who are interested to buy the bond that is issued by the bank, okay? But we also have this third party, right? So what this third party do is that investors can actually buy this CDS from a third party who will then agree to pay any outstanding amount of the bond in the event that the bank, that the lender defaults on this arrangement. Okay, so it is kind of like purchasing an insurance to insure against the risk of default by the bank. So this is how this credit default swap works. So back to the Credit Suisse event. What happened for Credit Suisse was that investors, they were actually rushing to sell Credit Suisse shares and bonds, and also to buy protection against a default in the near term, okay, which leads to the CDS, the price, the spread, to shoot up, to soar to a level that we last saw during the financial crisis in 2008. So the question is always, is it true that Credit Suisse is really collapsing? Is it true that Credit Suisse is going to be the next Lehman Brothers, or is it going to trigger another financial crisis? Well, my opinion is that I think that the situation is overblown if we look at the financials of Credit Suisse. Well, yes, Credit Suisse has been hit by some scandals in the past, and it's also true that yes, Credit Suisse has not been performing well in terms of its financial profitability over the last few years. Now, if you look over here, you can see that the revenue isn't doing well. The revenue has been coming down over the years, and likewise for their earnings, EPS, it hasn't been doing well as well. So fundamentally wise, it would not have passed many of our criteria to even want to invest in Credit Suisse stock itself. But having said that, the fact that Credit Suisse may not be a good business to invest in, it doesn't mean to say that Credit Suisse is going to collapse. That's two different matter, right? Those are two different matters. Whether Credit Suisse is going to collapse, whether it is near liquidation, it depends on the financial stability of Credit Suisse. That can then tell us more about it. Okay, so how we can look at this is this. Now, when we want to look at the financial stability of banks, one of the main ratios that we often look at is the CET1 ratio. Now, what is this CET1 ratio? Okay, so bear with me for this part. It might sound a little bit technical. Okay, what is CET1 ratio? Now, CET1 ratio, it compares the capital of a bank against its risk-weighted assets to determine if the bank has the ability to withstand financial distress. Okay, sounds very cheap. Okay, so firstly, what are risk-weighted assets? Now, risk-weighted assets are all the assets that a bank holds and that have credit risk. I give you an example. For example, the bank issues loans, right? So the bank loans, there is a risk of default. Okay, there's a risk that the borrower might not pay. So there is credit risk. So assets which have credit risk, right, is what they call risk-weighted assets. Okay. So to compute this CET1 ratio, this is the formula. Now you don't have to really go and remember this. Okay, I'm just showing you this just to let you understand what is the CET1 ratio, to understand what's happening. And the higher the ratio, the better the financial stability. That means when it's higher, it means it is more stable financially. So now let's take a look at the CET1 ratio of Credit Suisse. Okay, the good news is that we don't have to calculate all this up by ourselves. All the data, right? Typically, the banks will actually release their CET1 ratio. So we don't need to compute ourselves. So what is the CET1 ratio for Credit Suisse? You can see over here in Q2 2022, it is 13.5. Now, okay, looking at 13.5, you may not know whether it is good or not, right? So let's try and compare this against the US major banks. Like, for example, JP Morgan. JP Morgan, what is the CET1 ratio for 2022 Q2? We can see that JP Morgan, 12.17%. Bank of America, 10.49%. Next, Citigroup, 11.9%. So, in fact, Credit Suisse CET1 ratio is even higher than the major US banks, right? Like JP Morgan, Bank of America, Citigroup. Okay, so is it true that Credit Suisse is really on the brink of collapsing? I don't think so, in my opinion. Now, if you look at other ratios as well, such as, for example, the liquidity coverage ratio. Okay, what this is about is that it measures the ability of the bank to meet their short-term obligations without having to use outside cash. Okay, we can see that Credit Suisse, in terms of the liquidity coverage ratio, is actually performing better than its European counterparts. Okay, so now that we understand the financial stability of Credit Suisse, we can see that the entire situation has been exaggerated and overblown. Yes, it is true that Credit Suisse isn't doing well in terms of financial profitability. It may not be the best kind of investment that you want to invest in terms of equity investment, but does it mean that Credit Suisse is really going to collapse? Does it mean that Credit Suisse is near liquidation? It may not be true, okay? And this whole event, again, it just shows how scary it can be if you just blindly scroll through the financial news or scroll through our social media and we see things like this, especially during a period like this where stock market is not doing well, and you see news like this, it will make you panic even more and feel like, wow, I should sell everything because the whole market is going to collapse. So news like this, it can really screw up your whole emotions and psychology. That's why when we read financial news, when we read anything that we see online, on the internet, on social media, really, we take it with a pinch of salt. We must understand what is happening. And before we panic, we try and find out what the situation, what is really happening. Okay. Okay. So the third agenda on my list is to talk about recession. There has been a lot of coverage on recession by the media, as well as by analysts as well, about the risk of a recession happening, as the Fed continues with all the rate hikes. Right? So over the past few weeks, we have been seeing articles that talk about how there is a 98% chance of a global recession, or even you see numbers like 100%. Right? Quite recently, I saw this Bloomberg article, article about how Bloomberg study says that they forecast that recession has hit 100% probability. Now, I don't have the data for this Bloomberg studies, but let's take a look at the one that talks about a 98% chance of a global recession. So where did this 98% come from? Where did this number come from? It came from a studies by Ned Davis research firm, where they actually have this global recession probability model to study the probability of the global economy sinking into a recession. So let's take a look over here at the data that has been published. So based on their model, we are actually currently at the 98.1% level, 98.1% probability of a recession, okay? Which according to this model, it means to say that it is an indicator of a severe global recession signal, okay? And according to this model, the only time when the indicator has been this high was during the pandemic downturn in 2020. Okay, it was during the pandemic downturn during 2020, as well as during the great financial crisis in 2008. So the studies even went on to quantify, okay, so how the performance of the ACWI, how was it at during the various recessions, at various recession probability levels. For those who don't know, okay, ACWI is a global equity index. So it covers more than just US equity. For example, when we talk about S&P 500, it's only for all the US large cap equities, right? But ACWI is a global equity index. You have Europe market, you have emerging markets as well. So on first glance, this whole data looks pretty scary, isn't it? On first glance, it really looks quite scary. But let's see what else we can observe if we study the charts in more detail. Okay, so I've zoomed in here for the charts. So let's try and study this chart closer, okay? And what we can actually see is that whenever the recession probability model, whenever it peaks, it tends to coincide with the bottom of the stock market, okay? If you look over here, as well, here it peaks here, and it tends to coincide with the bottom where the stock market starts to go up here as well. Okay, not here, but okay, here you can see my arrow. So in fact, it's all the black color dotted that I have drawn out. Okay, not every single time, but most of the time based on the chart that they actually publish, right? So if Ned Davis recession model really peaks here, this is where we are currently. If it really peaks here, then that is actually good news for the stock market, isn't it? Because whenever it peaks, the stock market tends to be near the bottom or at the bottom. So if we really peak here, somewhere here, if we're going to peak somewhere here at where we are currently right now, that is good news, isn't it? Right? Then the next question you may ask is then, but I thought we are not in a recession yet. But all this, you see, all the historical data, they are already in a recession, but I thought we are not in a recession yet. Okay, so it hasn't been declared that we are in a official recession yet. So, but how is it possible that we can see, the bottom of the stock market if we haven't declared a recession? Okay, so now let's understand this. So in the US, we have this NBER, okay, which is the committee that will study the economy. They will disseminate their research findings, okay, and they are also the ones who will officially declare the peak and as well as the bottom of the economic cycle. In other words, when a recession actually officially starts and when a recession officially ends, okay, they are the ones who will declare that, okay? Now, but the problem for this committee is that they usually don't declare the start of a recession when it begins. That means that means the recession officially starts, but it will take some time before they declare that, okay, we have a recession. Okay, according to this Reuters article that was published back in 2008 during the financial crisis period, okay, they say that the NBER is well known for taking its time in declaring when recession begins. Okay, so let's see if this is really true, okay? Now, let's go to the NBER website. Okay, this is a screenshot that I took off from the website itself under the FAQ section. Okay, and under FAQ section, there's this question which talks about typically how long after the beginning of a recession does the committee declare that a recession has started? Okay, and what was the answer? The answer is that our determination, okay, for the last recession, right? Okay, it was in April 2002, right? They only talk about it in July 2021. Earlier determinations took between 4 months and 21 months. There is no fixed timing rule. So these are the words by the NBER committee, not words by me or by the news media, okay? So let's take a look at some timeline now. The most recent recession was in 2020, right? It started from March 2020 until April 2020. But when did the committee actually announce the start of recession? The recession started in March 2020, but it was only announced in June 2020. Okay, you take a look at the dates over here. It was only announced in June 2020. The recession ended in April, but it was only announced in July 2021 to say that, okay, recession has officially ended in April 2020. So they are usually slower, and they can be slower by many months. Same for 2008 financial crisis. It started in December 2007, but it was only announced in December 2008. That means only in December 2008 did they officially declare that, okay, the recession has officially started from December 2007. And when it ended in June 2009, it was only declared in September 2010. So they can really take months or even more than 1 year before they announce that it has happened. Okay, so for all we know, right, we may already be in a recession right now, okay, but it will take some time before it is being officially announced that, okay, a recession has started from when. And that is also why we don't need to wait until the media say, okay, we are officially in a recession before we can see the bottom of the stock market, because they are lagging, right? They will take some time before they talk about, before they release the data, before they release that we are officially in a recession. And that is also why the stock market, it usually already start coming down before the news talk about, we are officially in a recession. But when exactly is the bottom, or where is the exact bottom, I can't predict that, of course, right? No one can predict that. But I just want to emphasize and bring across a point that the key thing is really not to panic that we are going to get a recession, or when you see articles talking about, oh, we have 100% chance of a recession, 98% chance of recession. Because in fact, the markets may have already started pricing in for a mild recession at this moment in time. Now, the more important thing is really not to panic, but what should we be doing during this period? Okay, so there will be some who will choose to, of course, give up and then sell off their loss-making positions during this period of time in the stock markets. And there will be others who will continue to hold on to their positions. Now, which side do you want to be? We all know that, yes, bear markets, they are painful, but the markets tend to rise over the long term. All right, if we look at this chart, we can see that over the history, bear markets are painful, but markets, they rise over the long term. And in fact, for most of the time, we're actually in a bull market, right? All this, that dip at the bottom below the x-axis, this is during the bear markets. So that is why as a long-term investor, right, I want to continue to stay invested in the stock markets and in the good businesses. Even if in the next quarter or next few quarters, we may see that even for good businesses, some of them, their earnings may still be slightly impacted, right? Just like the recent, some of them have already announced their recent earnings, right? You can see that even very good businesses, they can still have their earnings being slightly impacted. Because actually that is pretty normal, you see. There is no one business that can be completely cut off from the economy, or that can always deliver results that beat estimates every single quarter. Now, Amazon can't do that. McDonald's can't do that. JP Morgan can't do that as well. Okay, so for those of you who still have extra bullets, you can continue to buy and add in tranches during this period of market pullback. Now, this is not a financial advice. Why we like to buy and add in tranches during the market pullback is because that will then help us to then average down the cost. Okay, if we can learn how to capitalize on these pullbacks to add positions of quality companies or even the S&P 500 ETF, you'll be able to reap a good return from these great opportunities. So here is just some simple math calculation. Say, for instance, today there is a stock, the price dropped from $200 to $150. Now, the drawdown is negative 25% at the moment. But if let's say you capitalize on the pullback and you buy new positions at $150, the next time when it goes back to $200, your ROI on this new position is 33%. It is not 25%. Likewise, if the current drawdown is 50% and you capitalize, right, and you buy at $100, you hold it all the way back until it reverts back to $200, your ROI is 100%. It is not 50%. Now, this is not magic, okay? This is just pure mathematics. But of course, this must be built upon the fact that you have the conviction. You must have the conviction in what you are investing in, that you believe it will eventually recover once this bear market is over. And you believe that it will continue up on an uptrend over the long term. Because that is how you will then have the holding power while you wait for the market to rebound. Okay? Okay, so the last thing on the agenda for today's sharing is on Singapore REITs, right? Because over the past few weeks, we saw how Singapore REITs have been coming down. Now, this is just the index, okay? But the same has happened for individual Singapore REITs counters. Okay, it has come down by more than 10%. So when it comes to headwinds that arise from the higher interest rates, right? What are some of the areas that we can actually look out for to determine how severe the impact will be on the REIT's financial performance? Okay, so let me share with you. Okay, these are also some of the main mechanisms that some of the Singapore REITs adopt to deal with the rising interest rate. So as an investor, the first thing that you can do is to understand how much of the loans that the REIT has is locked in on fixed rates. For example, if we take a look at CapitaLand Integrated Commercial Trust, it has 81%. It has 81% of its borrowings on fixed interest rates. Okay, over here, 81%. It may look a bit small. So what this means is that even if interest rates continue to rise in the short term, in the very short term, more than 80% of their loans are likely not to be impacted, okay? Because they'll continue to service these loans at the lock-in rate. And for CapitaLand, right, their average cost of debt is only at 2.4% as at 30 June 2022 when they released their earnings, right? And this is in fact slightly lower than what they have over the past few years. So typically, some of the REITs, they will also quantify, right? Sometimes they will actually quantify and say that, okay, assuming if let's say interest rate increase by 1% per annum, what is the impact on the DPU? So in this case, for CapitaLand, they have quantified that the impact is that it will reduce their DPU by 28 cents, by 0.28 cents, not 28 cents, by 0.28 cents, which is actually a single digit fall in DPU, about 2% if you compare it against the last full year of DPU of distribution. So you can see the impact is actually pretty small for CICT in this case. So this is one mechanism that some of Singapore REITs they may adopt, which is to lock in majority or a good proportion of their bank loans at a fixed rate during this period of rising interest rates. Okay, And the second approach that some of them will do for better capital management is that they will structure their debt profile in a manner whereby the loans do not mature all at the same time. And where the majority of their loans actually do not mature in the very short term, where right now the interest rates are high. So if you take a look at this graphical representation over here, you can see that this is a debt maturity profile for CICT. It is spread across the years, okay? Within the next 1 year, okay, the percentage of loan that is going to mature in 2023 is just 12%. And their loans are spread across a period of time. So they make sure that they don't have all their loans not maturing at the same time, okay? So this is the second thing that you could possibly look out for when you are analyzing the Singapore REITs, right? So, and these are typically some of the mechanisms that some of the REITs actually have that they put in place to tackle this rising interest rate problem. Okay, but of course they can't be totally 100% protected from the rising rates. That is not possible. Okay, they will still be impacted, but it is just a matter of how big the impact would be. Okay, and that is what we would like to find out. Okay, some investors, they have been asking this question, is it really still worthwhile to even invest in Singapore REITs at the moment right now? Because you see, Singapore REITs, the prices have been beaten down recently, down by more than 10% over the past few weeks. Is it worthwhile? Because right now we have investments like Singapore Savings Bond offering 3% and recently, just now I just saw the news about Treasury bills, 4 something percent for the last one. So is it still worthwhile, because Singapore REITs, if they only give me a dividend yield of 5%, 6%, do I still want to put here or not? Isn't it safer to just put in Singapore savings bonds? Okay, so now when we invest in REITs, we do not only want to profit from dividends. Most investors, when they talk about REITs investments or Singapore REITs investment, they only talk about the dividends. How much dividend yield we are earning, how much dividends we actually took this year. But they forget that the second way in which we can profit from the Singapore REITs from the REITs investment is also through capital appreciation. Now, because don't forget, REITs, they are also stocks as well, right? REITs, they are also stocks as well. So they go through price fluctuations. So in fact, you don't think that REITs, the price don't fluctuate. No, you look at what has happened during COVID, look at what is happening right now. They go through similar price fluctuation as well, just like what the US counterparts are experiencing right now. Okay, so but that is also precisely the reason why it is possible to earn capital appreciation over time. So under the current environment where right now we see many of the good Singapore REITs that are beaten down. And in fact, that actually becomes an opportunity where you can buy them at lower prices, where you can enjoy capital appreciation in the future when the prices rebound in the future. But that is again built upon the fact that you must have the conviction in what you're investing in. Because if you buy and then you see the prices continue to come down, you don't have the holding power, you sell, then that will still be a loss for you. Okay, so that's why many investors, when they talk about Singapore REITs, they only talk about dividends, but that is not true. Well, dividend is one way in which you can profit from Singapore REITs, one way in which you can grow your wealth through REITs, but the second way is capital appreciation. That's why if I only just look at dividend yield, is that a full picture for the ROI that I earn from Singapore REITs? No, that is actually not a full picture. Okay,